I'm John Olive, and welcome to Bloomberg Markets.
I'm Vonnie Quinn. Let's get straight to a quick check on the markets now. Here in the U.S., the S&P 500, well, it's really unchanged at the moment, but there are two diverging factors. One of them is that crude oil is tumbling out of bed today. There's a longer story behind that. We'll get to that in just a few minutes, but basically energy companies are a drag on the S&P 500, where some other companies such as tech would actually have the index higher if it weren't for that energy story. As you can see, WTI down 3.75%, below $70 a barrel. We're just awash in oil, and traders aren't believing those reports that say that perhaps exports are down. They're suggesting that we are seeing a build in inventories, even though this particular week's inventories, we did see a little bit of a shrink. Dollar Canada, loonie, it is strengthening today. We're off the highs for the dollar, Canadian dollar. This is after the Bank of Canada kept interest rates steady. And basically, John, it's sort of similar to the Fed, acknowledging that growth hasn't been the most amazing in the middle of the year, but at the same time, not quite ready to just say straight out that they are not going to hike again.
Very true, Vonnie. Yeah, I think a lot of people were looking at this decision today to try to get almost like a test run of what kind of language we're going to be hearing from the Fed going forward, because this is now the third meeting in a row that the Bank of Canada has kept rates unchanged. And like this dialogue in the market about the possibility of rates going down next year in the U.S., there are certainly plenty of economists that right now think that we're going to see a reversal in rate policy next year. But the Bank of Canada is still focusing on the fight against inflation and not quite ready to say that fight is completed. So against that backdrop, let's bring in Dawn Desjardins. She's chief economist with Deloitte Canada, and she joins us here in our Toronto studio. Dawn, what did you make of this? Because I think everybody expected they would be on hold again. People were wondering about what the language would look like. How did you assess it?
Well, I think, what they're trying to do is to say, we do think we're making some good headway on the economy. We certainly have seen slowing consumers, businesses as well. So definitely seeing the impact of these rate increases. Inflation's coming down, as they admit, and they point to some aspects like shelter, which being a little bit more sticky. I think what they were trying to say is that, things are progressing. Haven't achieved the total goal, so let's not get too excited about when we're going to be able to lower rates. But I think it's notable that they didn't say that the risks to the inflation outlook were increasing, as they did say in October.
And I think a lot of people are curious right now about what is the risk for central banks to shift away from that hawkish caveat, if you will. What do you think the Bank of Canada might be concerned about? That if they declare victory on inflation, since they're not quite there to begin with, but that would encourage more people to, I don't know, go, jump back into, for example, Canada's housing market?
I think they are concerned that, if they are perceived as not really giving up on the target, but not being, as assured that they're going to hit the 2%. Now, the governor himself has said it doesn't have to be 2 before we can start to reduce some of the tightening. But at the same time, I think 2 has to be in his sights or in the committee's sights. So it's not quite there yet. And I do think it is a concern that, we're balanced and perhaps a little bit in excess supply right now. But if we see rates go down, and we saw this in the spring, I thought that was quite remarkable. When the bank paused, suddenly the housing market caught fire for that spring season, which was quite interesting and remarkable.
Dawn, if you look at the WIRP function, the WIRP function on the Bloomberg regarding Canada, you see that traders are pricing in a rate cut around April. How can it be that in December, the Bank of Canada is not ready to say they're finished with hikes, that they might actually go another hike? They actually said that explicitly in the statement. And traders are already thinking in 4 months' time they could be pivoted already.
Well, I think markets, tend to get a little more excited than central banks would like. And I think that was part of what they were trying to do today by keeping this idea that, there's still some chance they may have to hike again. I think it was really aimed at tamping down future expectations of how quickly and how aggressively they're going to be lowering their policy rate. I think they want to communicate that while they may have to go, I don't think they will, but to the extent that they want to just keep that little air of caution, I think that's really why they were positioning themselves that way.
It's interesting. This week we had Mohamed El-Erian on Bloomberg Radio was talking about the markets taking on the U.S. Federal Reserve on a variable that the Fed completely controls. Is there an aspect here that we have to be mindful of? I mean, again, central bankers all felt, up against a wall for being late on the inflation fight. If the market is increasingly, and we saw that expectation that Bonnie was alluding to earlier, is increasingly expecting rate cuts maybe as soon as April, how does the bank internally feel about what the market's positioning is right now?
Well, I think the banks generally are not going to be succumbing to markets. We've seen many instances where the market runs away. But again, we can get a data point, and a lot of that can be retraced. And it is, it's a market. And so people are anticipating that perhaps the economy is a little bit weaker, perhaps inflation may fall a little more quickly, and that central banks, as a result, will get into action a little more quickly.
Dawn, the yield differential between Canada and the U.S. right now, at least on the 2-year, it's more than 50 basis points. Canada's 2-year yield today, about 4.06, whereas the U.S. 2-year yield, 4.59. What accounts for that massive difference?
Well, it really is, I think, that people are seeing an economy in Canada that's weaker, certainly than in the United States. The U.S. economy completely surprising to the upside, certainly in the third quarter. We do think we're seeing slowing momentum in the U.S. economy. But having said that, I think that really is, will the Bank of Canada have the opportunity to go ahead of the Federal Reserve simply because our economy is weaker? This will likely lead to inflation pressures decelerating more quickly and attaining that 2% target. Though when I looked at the markets, it did seem that, markets in both countries were looking for about 50 basis points of cuts by June, really in step with each other.
One of the other considerations, I guess, for where the economy heads from here is what's happening on the employment front, and we're awaiting a government jobs report in the United States later this week. The market this morning was reacting to some of the private payrolls data. When we got the most recent jobs report for Canada, it did show growth. But one thing about the Canadian economy that the global audience might be interested in is the fact that we now have record population, and that has been a key priority for the country. And that the jobs creation is not keeping up with the actual population growth, which is a sign of some underlying weakness.
Yeah, absolutely. And what we've seen, and what Statistics Canada's even stated, that if we want to have an unemployment rate that's steady, we need to have 50,000 jobs created every month. That hasn't happened really. We're looking at a 3-month average because the data is so volatile, and that hasn't happened for quite a few months. So as a result, we've seen our unemployment rate move up quite substantially. And we're also seeing it in job vacancies. They have also come down quite considerably, still elevated. But I think increasingly what we're hearing, and when we look at survey data, is that companies are pulling back a little bit in terms of putting jobs out there, wanting to fill those jobs, because of course they're worried about the economy. When you see a consumer that for 2 consecutive quarters basically has really stalled out, it's not a big leap for companies to anticipate a slowing in terms of their sales.